From ImpactAlpha, it's This Week in Impact, where we bring you some of the most interesting impact investing and sustainable finance stories of the week. It's Friday, March 21st. I'm Brian Walsh, and I'm joined this week by ImpactAlpha editor David Bank. We'll discuss how Trump's order to cut a Main Street lending program led to a rare GOP rebuke. Plus, how Canadian employee ownership trusts offer a path to shared prosperity, along with protecting national sovereignty. And finally, as private equity fundraising becomes more competitive, how GPs can differentiate on impact. That's all coming up on This Week in Impact. Hi, David. How are you?
I'm good, Brian. How are you?
I'm doing well. I'm in D.C. for the Impact Capital Managers Gala, and it's a beautiful day here in D.C. Spring is finally upon us.
I hear the cherry blossoms are in bloom, maybe a little bit early.
Yes, indeed. Well, speaking of D.C., first up, bipartisan defense for community lending. Community development financial institutions, known as CDFIs, operate in poorer rural and urban areas underserved by traditional big banks. These Main Street lenders have long earned bipartisan support for their ability to effectively leverage $1 in government funding to mobilize $8 in private capital. So it's been a whirlwind week as President Trump issued an executive order late last Friday directing the Treasury Department to eliminate, quote, to the maximum extent, its CDFI fund, a bipartisan program that provides critical funding to CDFIs. David, you and Amy Cortese reported this week on developments, including a rare pushback from congressional Republicans who support CDFIs. What have you learned?
Well, the CDFI fund, as you say, is part of the Treasury Department. President Trump ordered it to be eliminated as part of a Friday night massacre, maybe as it were, last week, which with about half dozen other programs. The one that got a lot of attention was the elimination of Voice of America, the parent company of Voice of America. But in that was also eliminating this program. It's only $324 million this year. In fact, it had just gotten reauthorized as part of the continuing resolution that they passed like hours before the executive order came down. But it's critical money for these CDFIs, as you say. It goes out as grants. The office also administers the new market tax credits and other sorts of things. We talked to Harold Pettigrew, runs the Opportunity Finance Network, which is an association of CDFIs, and here's what he said.
Oh, it's critically important. I mean, I think the CDFI fund itself is critical to the financial industry. So it's not just to direct CDFIs that are certified, but the number of institutions across the board that leverage programs that are administered by the CDFI fund. When you think of the New Markets program to Bank Enterprise Award, there's so many programs that enable community investments to take place. That it to me is one of the most efficient public-private investments that the government actually runs. It's an efficient source of leveraging a minimal amount of public dollars to catalyze private investment.
So the CDFI fund sounds like a shining example of successful public-private partnership, something that has long had bipartisan support. So where has the pushback come to Trump's executive order?
Yeah, well, it's one of these things that starts out partisan but becomes bipartisan just because it's so, useful and effective. So, it dates back to the Clinton administration, but it's been reauthorized ever since. And as people may remember, in the pandemic days, CDFIs played a huge role in getting out Paycheck Protection Program money to small businesses that kept them afloat through the shutdown, as well as more recently, and we've been reporting a lot on their role in the green bank lending scale up under the Greenhouse Gas Reduction Fund, which is also under attack from the Trump administration. But CDFIs have, as you say, developed a bipartisan constituency. I think there's 28 senators, 14 Republicans, 14 Democrats in a community development caucus in the Senate. Senators Warner and Crapo issued a bipartisan statement of support after this executive order came down. Representative Young Kim out here in California, Republican on the House Financial Services, called the CDFI fund a lifeline for underserved populations to access capital and said deserves our continued bipartisan support. And even Treasury Secretary Bessent, who had called them very important in his confirmation hearings, seemed to come out and say he would take a close look and see what he could do. That's about as far as an administration official can get now, out of line with the president. But it seems that there is support both within the administration and on the Hill to keep the CDFI fund alive.
So when will we know more? What are the next steps in this process? I know the executive order gave them a week to kind of justify continuing these programs.
Yeah, and it was sort of mince no words. It said, anything that's statutorily required could continue to exist, but that it should be kind of funded and run at the sort of most minimal level. The big defense, of course, of the CDFI advocates is that it is statutorily required. It's been in the law since 1994, and as I said, was reauthorized. The funding was reauthorized as recently as last week. Here's Harold Pettigrew again.
Well, I've kind of plainly said, David, if you support small business and affordable housing and childcare and that all of those things that we need, in our communities, whether it's a rural place, a city, it doesn't matter the location. We know those are needs in our communities across the country. That's what we support.
All right. Well, you can read Amy and David's article on the bipartisan support for the CDFI fund on ImpactAlpha.com. There's also a link in our show notes. But let's take a quick break, and when we come back, we'll discuss the new Canadian model for employee ownership trusts.
ImpactAlpha is going on the road for the launch of our new project, Reconstruction, Building Models for Shared Prosperity. It all starts in North Carolina on Friday, April 4th, at our in-person convening at UNC Chapel Hill. We're teaming up with Good Trouble for a free day-long event focused on the Tar Heel State's impact ecosystem. We'll have a special screening of ImpactAlpha's first mini-documentary, Equity and Ownership, Napoleon Wallace and the Reconstruction of Black Wealth. Then it's off to Washington, D.C., Boston, and New York for more screenings and face-to-face networking with other agents of impact. Be sure to read the brief for more details on each event. Hope to see you there.
In an era marked by growing wealth inequality and shifting economic landscapes, a new model out of Canada has emerged as a potential tool to preserve local prosperity: employee ownership trusts. More than just a financial mechanism, these trusts offer a strategic pathway for workers to gain equity and ensure companies remain rooted in their communities. Our Rudy Sonatas reported on the first employee ownership trust that's emerged following Canadian legislation passed back in June 2024. David, ImpactAlpha has been very focused on this ownership economy beat. What's compelling about this new Canadian model?
Well, yes, the first firm to convert under this employee ownership trust, a small advisory firm called Grant Book, and it's got 50 employees, and they're now the majority owners of this small firm. But there's a couple dozen in the pipeline, and it's become a little bit more salient as Canada faces a kind of a trade war and a kind of war of words with President Trump. He wants to make it the 51st state, and so there's kind of become a kind of nationalist cry that these kind of employee ownership transitions can actually keep Canadian firms in Canadian hands instead of perhaps being scooped up maybe by American private equity firms as the owners retire. So it's gotten, both a share the wealth cast to it, but now also a sort of national sovereignty cast in Canada.
Now, in the U.S., we have ESOPs, which are employee share ownership plans. How is the Canadian model of employee ownership trusts different?
Yeah, there's nuances between both ESOPs in the U.S., as you said. There's also employee ownership trusts in the UK, where many firms have converted, and then Canada wanted to get kind of in the game with its legislation. And the difference, I think, is that the trust in the Canadian, I think in the UK version as well, the trust owns the shares rather than the employees directly, and there's trustees that manage the trust on behalf of the employees. So there is profit sharing, and the actual equity is held by the employees, but it's not held directly as an ESOP ESOPs, and that has a bunch of sort of technical advantages. One of the problems with ESOPs is that the shares would get distributed, and eventually former employees would end up owning the bulk of them, and there wasn't much equity room for new or current employees. So they all have their kind of different flavors, but they're all a version of getting employees a stake in the companies without requiring them to actually put more cash down, and also not requiring them to sacrifice on wages or benefits in the meantime. So the company itself, in a sense, buys the shares out from the current shareholders and holds them in trust for the employees.
How do these employee ownership trusts, how do they help keep Canadian businesses in Canadian hands in the face of what is seen by our neighbors up north as U.S. aggression?
Well, the argument is the same as the argument, for employee ownership in the States and frankly anywhere, which is there's a kind of age wave, people call it the silver tsunami of maybe baby boomer business owners that want to exit their companies, and they only have a few options. One has been sell to your competitor, another has been sell out to private equity, and then a third is sell to your employees. And so the Canadian cry has been that the private equity firms, just by dint of the number and the amount of firepower they have been generally American private equity firms, and so they could come in and scoop up Canadian companies, just like they're scooping up U.S. companies. And so one way to keep ownership local is to sell to the local employees.
All right, now these employee ownership trusts, I understand, will be a component of the call that we're doing next week, the Agents of Impact call on Wednesday, March 26th. Tell us about that event.
Yeah, well, as you say, we've been leaning into this ownership economy, and we've got a good range of folks to talk about some of these new trends. So we'll have John Shell, a Canadian who's been working on the employee ownership trust and other models up in Canada, and then Alison Lingain of Ownership Capital Lab, and she's got a new report out about the silver tsunami, and she's also got almost 24 employee ownership funds that are raising a combined something like $670 million. So lots of investment opportunities for impact investors. And then an interesting new model from the Essential Owners Fund, which is keying specifically on kind of frontline, essential workers in food and agriculture and senior care and transportation and logistics, and helping them transition to employee ownership. And finally, Jack Moriarty from the Lafayette Square Institute, and he's been really taking the lead on mustering some of this bipartisan support, because ownership really is a kind of issue that does cross party lines. It both shares the wealth, that's good for one side of the aisle, and it also is a kind of free market and up by your bootstraps kind of strategy, and that appeals to some other folks. So as you say, join us on Wednesday, March 26th at 10 in Pacific time and 1 o'clock Eastern time.
All right, we'll have a link to RSVP in our show notes, where you can also get a link to Rudy's full story on the Canadian Employee Ownership Trust. But for now, let's take one more quick break. When we come back, we'll discuss how GPs can differentiate on impact as private equity fundraising becomes more competitive.
Maybe it's a story in the brief, or our monthly Agents of Impact calls, or an exchange in one of our subscribers' Slack channels. ImpactAlpha is all things impact. Hi, I am Slayma Bibel, co-founder and Chief Operating Officer of ImpactAlpha. For more news and insights about the world of impact investing, join thousands of others finding alpha and impact. Visit impactalpha.com/subscribe to learn more.
Our Amy Cortese was at the Super Return Private Equity Conference in Miami this week, where she learned some super signals for our LPGP beat. Amidst the turbulence of President Trump's escalating trade wars, dealmakers have shifted their previous expectations of an economic soft landing and private equity recovery after several years of delayed exits and slow fundraising. So, David, what were some of the key trends that we've been hearing?
Well, it's interesting. The private equity trends, broadly speaking, are kind of moving in impact investing's direction. So, as you said, with tough fundraising and kind of the need to differentiate, impact has become something that private equity fund managers are stressing, even if they're not kind of classic impact investors. People are making the case that mission-driven companies have better retention, better, obviously, PR in some cases, and also maybe lower cost of capital in various ways. So people are making an argument that impact can be a differentiating factor, in a private equity firm, even if it's attracting traditional LPs. We had Damien Dwin from Lafayette Square talk to Amy and said that that it's a shame that many folks have been missing out on what he calls the ability to invest in working class places and working class people, and that you can get kind of good solid returns compared to other asset classes with low volatility, a huge impact, and that's something that folks are missing out on. He's obviously trying to differentiate himself on that.
Now, the private equity industry in itself has really differentiated in the investing world. It's tripled in size in just the past decade to nearly $4.7 trillion in assets under management. So what does that say about where we are right now in the capital markets?
Well, one sort of mega trend has been that the private markets have, sort of expanded. Companies are staying private longer. More things are kind of happening in the private market. Private credit, obviously, is a major trend. And so one trend is, how can retail investors who've been largely locked out of private markets play a role? I mean, there's been a restriction to accredited investors, above a certain net worth, ostensibly to protect them from investment risks, but also tends to keep retail investors or smaller investors out of some good opportunities. So there's moves to, for example, let retirement funds, 401k funds, get into private equities, and that would be obviously a major boon to some of these private equity firms. But it might also be a boon to retail investors who've been kind of stuck in the S&P 500, which is so concentrated in a handful of tech companies. So it actually may be a diversification move for retail investors.
But one of the challenges with private equity is just in its name, it's private. So there's this kind of inherent lack of liquidity that you don't get in the stock market. So how are the current liquidity challenges playing out in the private equity space?
Well, in fact, liquidity is sort of the watchword at a place like Super Return, because the funds have been very slow to return capital to their investors as exits have slowed, IPO market has slowed, M&A market has been slow. That was all supposed to unlock this year, by the way, under Trump, and now with the tariffs and the maybe incipient recession, some of the high hopes for that have been put on hold. But as you say, the retail investors, generally speaking, would like to have higher liquidity than some of the more long-term private equity players. And there are moves, ways to provide liquidity even in a private equity fund with ways to buy out every so often. So these are the kinds of I guess market innovations that are underway to make private capital a little more public.
And another trend that we've discussed on this podcast before is that the tension, if you will, between LPs and GPs, as LPs, seek to have lower fees that they pay to their GPs. And one thing that I noted in Amy's article was that 30 cents of every $1 committed to private equity these days comes without fees attached. That means probably co-investments or direct deals that the LPs are doing alongside their GPs, because they have the leverage, so to speak, in negotiating for these more favorable returns.
Yeah, exactly, and it makes the numbers that some of these private equity firms report, assets under management, you have to sort of now pull those apart, because it used to be that you could kind of do the math and figure out what their fees were and what their size of their own business is. But as you say, now they're sometimes holding or deploying capital that they don't actually get any fees on, and so the assets under management numbers are maybe a little bit inflated.
All right. Well, you can read Amy's full piece on the changing private equity landscape on ImpactAlpha.com via the link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you, David.
Thank you, Brian, and thanks to all the listeners.
Yes, thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the strategic advisory firm Human Nature. We'll see you next week for more Impact.